Still a lot of risk in the market. When you look at it, 2,900 just simply balances the high PE multiples you get from low interest rates, low real rates, against the earnings risk of a recession by mid-2020, which is what the 50-day moving average of the 10-year minus 3-month curve would seem to indicate.
Do you think we're overreacting to ISM given the GM strike, given what some of the regional surveys have said and, that are slightly different?
Within all sectors, manufacturing has the highest gross value added as a percent of GDP. It does matter, and it can lead the PMI services, non-manufacturing lower. We'll get that tomorrow. But I would say there has been leakage from the weak economy overseas into the U.S. market, and we're seeing the effects of that now.
All right, so you're in. A lot's riding on services, and then on BLS Friday. What's your take on the week so far?
Yeah, certainly the Fed is not in an enviable position here because they have to balance, a pretty strong consumer-driven economy with, all the data that we know, lowest unemployment in 50 years, rising wages, strong housing numbers. But, as Barry points out, and he's done a great job sort of capturing the whole narrative of the market over the past couple of years, is that we're basically in an industrial recession, a global one. And it does remind me to 2016 to even 98, where the U.S. was okay, the rest of the world was not. And if you look at the ISM, 48, the lower it goes, the better your forward returns get. But it all depends on whether the bottom is here or at 40, 6 months from now. And that could be like catching the falling knife. So it is a very tricky period here where you just don't know where the bottom is going to be and whether the decline on the industrial manufacturing side is enough to tip the entire economy over. And again, for the Fed, it's a question of, do they look at forward-looking indicators like the yield curve, like the bond market pricing in 3 more cuts when the Fed probably doesn't want to do any more? Or do they look at just coincident indicators, which of course are coincident and not leading? So it is a tricky time. It's also the fourth quarter. It is the earnings season is coming up this week. And the 2020 number, as Barry said, is too high at an expected rate of 10%. Usually the fourth quarter before that year is when the number comes down. So it's very likely that 10% is going to end up closer to 5%. And so that has to get priced in as well.